Hi guys, this is Mark Shawson, the Pattern Trader, and frankly I think today's video could be one of the most important ones that I've done. And while I'm very excited about the money-making opportunities ahead, I'm also very concerned for traditional investors, and I'm going to get to that in just a moment. So I see two huge emerging trends happening right now. One is the US dollar has peaked above weekly resistance highs and now is continuing on the path that it started in April, and we are looking at lows in the euro at around 113 and the British pound at 127. And I think this dollar trend is going to continue. I think you could see ultimately parity with the euro. But the subject I want to talk about this morning is the stock market, because there are millions of traditional investors who've got their IRAs, their pensions, their mutual funds, their lives tied up in the stock market. And what I've been seeing for the last couple of weeks are omens of a major turn. Now, I think it's pretty important to note that today is October 27th. I think it's October 26th. And we are a hair before the market opens, about an hour before the East Coast market opens. And the markets are collapsing in the aftermarket based on the announcement and release of Google's earnings overnight. Now, that's just a catalyst. These markets have been setting up for the last couple of weeks. Back in September 7th, I did a video on my weekly Sunday report showing a small inside weekly bar on both the Dow Jones Industrials and the S&P, and noted that those little benign, innocent looking inside weak bars were very oftentimes the signal and a catalyst for a reversal. And that's exactly what we've seen. The indexes are down about 8 or 10%, one of the worst months for about 10 or 11 years in the NASDAQ, the S&P, and the Dow Jones. But unfortunately, I think that this trend is just starting, and we have now laid out patterns that for me signify that the direction where the market has been going, which has been ever higher for the last 10 years, is about to reverse. And these patterns are immutable in their representation, meaning that when you see them, you know what they mean, and you either heed their signal or you ignore them at your peril. Now, in terms of the daily NASDAQ 100, this is a proxy for the tech sector. We've now traced out a double top, head and shoulders, where actually the right shoulder is lower than the left. And the implications of that are, number one, that it's very bearish, and number two, the market is likely to go down very quickly once it penetrates this neckline, which it's sitting on right now. We had a huge day yesterday. The market went up, but these up days are just an illusion. This is now an environment to sell the rallies, and now even in the aftermarket, before the market session opens, we're now trading under yesterday's lows. And so just a huge move lower before we even start the trading day. Now, what's significant is also the date. We're in October 26. Now, the Wall Street crash in October of 1929 occurred in October 29th. Black Monday, which was a huge crash in the market, one of the worst percentage declines in history, was October 19th. So for some reason, end of October has spelled a pretty unique time for crashes of the stock market. Now, and I was a broker on Wall Street, and I remember Black Monday. It started on Friday with selling in Hong Kong, and it was a huge day down. It was about 200 points down, but remember, the Dow Jones was only trading at about 5,000 at the time. And then on Monday, the selling came in earnest. And the Dow was about 2,500, because on Monday, the market came in and, after the Friday selling, dropped 500 points, which represented a 25% decline in one day. It never had happened. Even in the crash, we'd never had something this big. So now, we've got a massive selling going on Friday, which may just precede something on Monday. But either way, there is huge omen sitting in the stock market. If you're long, if you have mutual funds, you need to start getting out. I'm not trying to be hyperbolic. I don't like to talk in panic terms, but these patterns, I know what they mean. Now, in terms of the Dow Jones and the S&P, they are on their way to forming long-term double tops on the weekly chart. The S&P needs to get to about 2550. We're trading at about 2650 now. The Dow Jones needs to get to about 23,500. We're now 24,500. So once we get to those levels, and if we get to those levels, this will confirm very long-term bear patterns in the stock market. Now, I've also been looking at individual stocks for a long time, and frankly, the indexes don't even start to represent the carnage that has been created in the general stock market. Starting with the financial stocks, I looked at Goldman Sachs. It has a huge triple top going back a year at about the 295. We're now trading at $210. JP Morgan is trading at $100. Citigroup, Wells Fargo, all of the insurance companies. So typically in a a rising interest rate environment and a healthy economy, these financial stocks should be doing well. Instead, they're getting decimated. This is an indication of some boogeyman out there that we're yet to know. And here's the thing, we are not in a recession. There's not even a talk of a recession for the next year or two. Earnings are still fairly good. There's a lot of complacency. I was watching CNBC the other day. Jim Cramer says, this isn't a time to panic. Well, I'm sorry, what I'm looking at, I think this is a time to panic. You need to get out, and if you're aggressive, you need to get short because of what we're seeing. Now, again, all of these individual stocks are breaking down. You have a double top on Amazon. You have a triple top on Google, which then presaged what was going to happen after their earnings last night. So it was no mystery to me that we have the collapse now, because a couple months ago, Google's got a triple top bear price pattern. On a webinar a couple weeks ago, I was looking at the stock of NVIDIA, also with a double top. We were talking early in the morning. I had 600 members on, and as the market opened, I looked at NVIDIA. It opened higher. I said, you need to sell into this. And NVIDIA was trading at about $247. It went about $190 yesterday, and it's going to go a lot lower. So we need to take this seriously. There's great opportunities if you get short, but again, a lot of people are, traditionally situated on the long side. Now, again, what's interesting to me is these markets are crashing without any ostensible reason. Earnings are still reasonable. We're not in a any kind of recession environment yet. Rates have sneaked up just a little bit, but there's some boogeyman that we don't know yet, and that's the thing. Prices are ahead of the information. The real information and why this is happening won't be revealed maybe for 3 months, 6 months, 9 months, but by that time it'll be too late. Now, one of the things that, I've got a sneaky feeling, these things always start with that 4-letter word, debt. If you look at the 80s, we had the junk bond and savings and loan crisis that brought down the market. In 2008, it was subprime. Now there's a little thing called leverage loans. Now, they're not so little anymore. This market has doubled in the last 6 years to $1.2 trillion. And at their September meeting, where the Fed usually talks about tight labor markets and low growth and all of that kind of stuff, they raised a flag on these leverage loans and said in the minutes that these leverage loans posed a threat to financial stability. So basically, these leverage loans are given to clients with less than credit-worthy capability. So typically, this used to be junk bond customers. Leverage loans, sit below junk bonds. They're a tier, a piece of crap lower than a junk bond. And you don't have to have good collateral. And just like they always do before, Wall Street is starting to package these things in collateralized loan obligations, which means that they've been starting to sell them to investors in the form of mutual funds. And we know how this always works when it unwinds. This is how the subprime crisis started in 2008, and we obviously didn't learn the lesson there. So to me, we're now $21 trillion in debt in the national debt for the U.S. government. So every time rates go up now, our payments have to go up. We have $13 trillion in consumer loans, student loans. We, have debt up the yin-yang. And I don't think it'll take much of a spark to start unwinding this thing. And I think this is what we're seeing, because there's no reason for this panic selling in the market, but it is going on, and you need to pay attention to it. So again, we are trading at below lows of yesterday. The market is coming off, and you need to kind of get a cooler head and take advantage of this, or position yourself, get into cash, get out of the stock market. So there are two inverse ETFs that I like. They're pretty conservative. They go the opposite direction. So if the market goes down, they will go up. One is the S, like Sam, QQQ. So this is an inverse ETF. It's a triple ETF. So when the market goes down, this will go up. It's trading around $15, and probably a good way for you to be positioned. Another ETF that is linked to the technology sector, which I think is just going to crater here. I think you're just starting to see, Netflix was over $400 just last week and went under $300. You're talking about a $100 move in 1 week. Imagine what 3 or 6 months of an environment like this will create, the devastation. So another ETF is TECS. So take a look at those. You may want to start feeling them out, getting positioned in them. So again, I'm going to sign off now, going to check out the markets, but take this very seriously. These patterns, what they're foretelling, and the omens that they present for traditional investors are serious. So with that said, I wish you a healthy trading day, and I'll speak to you in my normal format on Sunday. Take care.